Okay, if you guys are ready, we can get started. So welcome
Sure.
everybody. Thank you for joining us today for this webinar hosted by HNB Realty. Today we have a great topic, the power of the 1031 exchange in transferring assets. And we have two great speakers for you today. Let me change the slide. So our first speaker today is going to be Ben Plouvier. He is the founder and managing broker of HNB Realty. He has been a real estate entrepreneur and investor in the Houston Metroplex market since 2008. His skill set has led him to consistently deliver superior cash-on-cash returns with his client base. And through his real estate investment company, he guides clients through their entire investment journey from acquisition to asset management and resale. He's done over 100 real estate deals and has over 40 returning clients. Joining him today is Ms. Cindy Pham. She is the South Texas Louisiana Division Manager with Asset Preservation, Inc., and has been in the real estate industry for 20 plus years. Cindy has an extensive background in IRC 1031 tax-deferred exchanges and every aspect of real estate transactions. She focuses on educating and servicing investors, attorneys, real estate brokers, agents, accountants, and financial advisors. She has over 20 years in real estate and over 200,000 real estate deals. So thank you so much, Ben and Cindy, for hosting this today. We're excited to learn, and let's take it away.
All right, great. Thanks, Sandra. Thanks for the introduction. I'll just go through a quick little disclaimer. All the numbers and information you see here is just for information. It's part of Cindy's database and mine. We're not soliciting the sale of anything here. This is just for information purposes. We may discuss forward-looking statements. Again, those are just a little bit speculative and for information. So with this said, we're going to take this pretty quickly. We're going to start with a business case that we did here at HNB, where we partnered with Cindy's team, where we helped a California investor transfer his assets from California to Texas, and doing that tax-free. And that tax-free vehicle is what Cindy helped us with, and she will go through the basics of the 1031 exchange. So quickly, I've only got a couple of slides. So this investor came to us. This is our analysis of what his asset was performing. So he came to us. His asset was worth $640,000. His monthly income was $2,000, and you can see he was only returning a net cash flow of $400 a month. So he was relying only on appreciation. His cap rate was 0.74%. So when he approached us with that, we obviously talked about it, and we recommended for him to transfer his assets to Houston, where we could definitely improve his numbers and generate more positive cash flow return. He did have a requirement, is he wanted a similar appreciation rate that he was seeing in California, which we do have in Houston. We've been doing about 5% over the last 15 years on average. And he wanted that single family asset to keep the stability of his tenant base. So that was his requirement. And this is what we found for him. So with by selling his asset tax-free, we reinvested it pretty quickly into two single family homes here in the Houston area, where basically you'll see, I'll just show here. So we went basically from a net effective cash flow of 400 to 2250 by doing this operation and keeping the same appreciation, or at least anticipated appreciation rate that he has in California. So he was pretty pleased with that. Some of the things you could notice, the cap rate is a little bit lower on these assets, even though he actually got a good deal. We've had a run up in appreciation. I mean, a lot of people are aware of that. But we are getting rent growth now. The two are usually correlated. So he should see some rent growth on these numbers that we have here. So we're expecting that to go back to more the norm for single family between the 5 to 6 range. So he did this operation, and he did have a lot of appreciation in his California asset. We did that thanks to Cindy, really, doing it tax-free. So Cindy's going to walk you through a little bit of the basics, really, in 1031 exchanges and what it entails, and that should help frame some of the discussion. So this was one business case. A lot of people use 1031 exchanges for different things, and I think you'll probably touch on that too, right?
Okay.
All right, here you go.
Thanks.
Thank you, Ben. Sorry, Cindy, before you continue, just want to welcome everybody who's joining us now, and just letting everybody know, feel free to type in your questions in the chat, and we will get them answered for you. If there's a specific thing that you're interested about, or a topic that or a speaker's cover that you want to learn more about, please make sure to enter your message in the chat. So thank you. Cindy, you can continue.
Thanks for having me. Just as my disclaimer, we all have to do disclaimers. So asset preservation, we're the intermediary for a 1031 exchange. We're a qualified intermediary. So you'll have to use a client that wants to defer the taxes will need to use a 1031 exchange qualified intermediary to facilitate the 1031 exchange. And as an intermediary, just as a disclaimer, I don't give tax advice. I don't give legal advice, and I certainly don't give real estate advice as well. But I do, talk through, assist clients, and just kind of help them understand the tax code and the rules and regulations around that. So this is the tax code. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either productive use in a trade or business or investment. So that's the actual tax code. For those that are not familiar, the 1031 exchange is also referred as a like kind exchange. It's a tax code that the IRS allows taxpayers to defer capital gains taxes when they sell their investment property or property of a trade or business and reinvest into another property. That's an investment property or a property of a trade or a business. I want to point out the first line, no gain or loss shall be recognized. This is non-recognition treatment. So the IRS, our government uses tax code to drive our economy. So when you have a property of investment or a trade or business, think of it as it contributes to our economy. Okay, so if you've got an investment property, it may be provided a place for someone to live as a renter. It could be a business. There's the people that gives you the insurance policy. There's the lender involved. There's the appraiser when you purchase the property. There's the handyman, the maintenance man. This investment property contributes to our economy. Now, if you sell this property and keep the money to yourself, the IRS is going to tax you for the capital gain. It's going to be recognized. They're going to recognize that you made a profit, your gain. Now, instead of keeping the money to yourself, you're going to reinvest the property to reinvest the funds, all of the funds, into another investment property. Well, guess what? That is recontributing that money to our economy. Okay, you're not keeping any of that. That means the lender is doing business, the appraiser, the realtor, the title company, the handyman that doesn't make it ready, the insurance guy. So this contributes back to your investment property contributes back to our economy. So therefore, the government says, I'm not going to recognize that you have a capital gain because you didn't keep in the money. Now, anytime you pull out the money, they're going to recognize the gain. So this is what this tax code is based on. It's a non-recognition treatment if you reinvest into another property of a trade or a business. Just going through terminology that you hear a lot in 1031 exchanges. Actual receipt. If you want to do a 1031 exchange, it has to be done before you close. Actual receipt, if you close on a property and you receive the proceeds, it's too late. Okay. Now, today I actually had a client call me that they actually signed docs already. The title company called me. They didn't know that the client wanted to do a 1031 exchange. She called me. She said, I signed the docs yesterday, but I haven't touched the money yet. And I asked her, well, did the buyers sign the docs? She's like, I'm not sure. I think so. I go, well, you need to verify with the title company, because if buyer and seller signs the closing docs, you're closed. Even though if you've not touched the money, you're in constructive receipt. And by the way, as an intermediary, I should have explained it earlier, that as an intermediary, we hold the funds in between the seller, the investor selling the property and buying the next. So we facilitate it by holding the funds in between. So therefore, if you sell your property and closed on it, you're entitled to the proceeds already. It's too late to do the exchange. We have to be involved before. I mentioned earlier, the 1031 exchange is also considered, is also called a like-kind exchange, okay? So boot is a term that you do hear often, and boot, when you hear boot, boot means it is not like-kind, and you pay taxes on anything that's not like-kind. There's two types of boot. There's a cash boot and there's a mortgage boot, okay? So you don't have to, when you sell your property, you don't always have to do a full tax deferral. Okay, so let's say you're selling your property, let's say you sold it for the $640,000, but I don't want to reinvest the full $640,000 into the next property. I only want to invest $550,000. I want some cash back and pay taxes because I want to use that money for my own personal use. So that $90,000 that I received at closing, it's my cash boot. The mortgage boot is the debt. So let's say of that 640, let's say after 640 you netted out 600, but of that 600,000, I still owe 200,000 to the bank. That's my note. So that number, the IRS doesn't care if that money, that net number, is all cash or part of it is mortgage, your debt. You have to replace the full 600 for a full tax deferral. Okay, so the mortgage needs to be replaced. In the 1031 exchange at closing, when you sold your property, that note, that 200,000 got paid off. So I'm actually only holding as an intermediary to $400,000 of cash, but you still need to replace 600,000 because the mortgage needs to be replaced on the new property as well.
So you mean we need to take at least $200,000 of mortgage in the like-kind, or more in the like-kind exchange?
So an easy way to think of it, for a full tax deferral, you spend all the cash and have the same or greater debt.
Okay.
For full tax deferral, unless you want cash back, you want a cash boot, you just receive that at closing and then you just pay your taxes on it. And same thing, if you purchased a property, let's say you sold your property, you netted out 600, but you only found a property here for, let's say 525, and then you receive 75,000 at the end of closing, you just pay taxes on the difference of what you receive.
Right, right. And that's what the investor before did. He didn't fully reinvest. I think he had a very small boot, 10, 20,000.
And then also, we always recommend our clients to speak to their CPA, their tax advisor, because you don't know if the client has losses at the carry forward. So that will offset some of that boot as well.
Yeah.
Thank you, Cindy. We do have a question from Ilya. She's asking, does the value of the property post depreciation matter?
Yes. So to calculate your capital gain, it's going to be your net sales price minus your net adjusted basis, your net total cost, and which is going to be your original sales price plus your improvements minus your depreciation. Okay, now if you're going to be taxed, I think I'll go through some of this later on too, but you're going to be taxed on, there's 4 levels of taxes that you'll be taxed on, which is going to be the depreciation that you've taken on the property is going to be taxed back at 25%. Your federal capital gains, there's the net investment income tax, and there's the state taxes. So those are the 4 levels of taxes. These are just the terminology, but I can kind of move forward. But as far as a few important parts I want to point out, the client is always, the investor is always the taxpayer. We always want to figure out who is the who's the taxable owner to the property. Are you individually the the taxpayer, or is it your company, your LLC? Now, if you have an LLC, is it a pass-through company, or does it pay its own tax? Is it its own taxpayer? And also, you know, let's say if you're the individual, well, are you married? Okay. Now, even though if it's just you on the deed and also on the contract, on the title report, it's only just you, but does the IRS recognize you and your spouse as the taxable owners? You know, do you file taxes together jointly? You know, do you claim taxes together? The exchange period is going to be 180 days. You have 180 days to complete your 1031 exchange, but within the first 45 days of the 180 days is your identification period. You have to identify what you're going to buy. And identifying just means I'm going to identify it. I'm going to consider buying one of these properties that I put on this list. I'm going to submit back to formally to the qualified intermediary or the title company, and that's officially identifying. And you have to purchase one of the any of the identified properties on the list in order to defer the tax on your relinquished property, which is the property that you're selling. And then the replacement property is the property that you're going to purchase. So right now we've got our perfect storm for 1031 exchanges. So if you remember that movie with Mark Wahlberg, it's this three massive storms that collided with each other. And why are we in our perfect storm? We have higher taxes. And right now we're going through another tax change very soon for 2022 under this current administration. We also have the 3.8% net investment income tax was added. It's also known as the Medicare tax or the Obamacare tax or surcharge. With a strong market, we have higher taxes. So doing a 1031 exchange, it kind of alleviates the burden of taxpayers to pay the taxes. Now, I mentioned earlier, there's 4 levels of taxes, the depreciation recapture. So on a property that you own and you've got a structure on it, your tax person will probably depreciate the wear and tear of the building. Whatever you depreciate over the years is going to be taxed back at 25%. That's the depreciation recapture tax. These numbers, by the way, it's according to 2020 taxes. So when we file taxes for 2021, my numbers are for that, because it changes every year. And so in 2022, my taxes for 2021 will change again. But your federal capital gains taxes is going to be 15 or 20% depending on your income bracket. The net investment income tax, which is going to be 3.8% depending on your income bracket. And then you have state taxes. There's about 7 states that don't have a state income tax. So yeah, there's about 7 states that don't have a state tax. So a lot of times our investors do have state taxes.
Yeah. So I guess in the case just before the California investor, he held that maybe 10 years or so. So he depreciated his asset 27.5 years. So he depreciated a good chunk of his initial purchase. Then he had the capital gains from his basis to the 640, and then he would have paid net investment income tax. And then being in California, he would have been hit also with state taxes on that sale, probably.
Yeah. Absolutely.
So
Absolutely.
Yeah, that would have been a big deal.
So the capital gain taxes for 2021, so this is based on the 2020's income. Okay, so if you are a single filer and you make over $441,550, you're at the 20% tax bracket. If you are a married couple filing taxes jointly and you make over $496,600, you're paying the 20% tax bracket. Below that threshold, you're paying 15%. And if you notice, between being single and being married, there's a slight difference, right? The difference is very little. So there's a little penalty there for being married. The net investment income tax that comes, that's a 3.8% tax for single filers that make over $200,000, and for married couples that make over $250,000. That's basically what that tax is on unearned income. So money that you've made without physically working for. So which includes your interest, your dividends, your capital gains, your retirement, your Bitcoin. And so that's what you're being taxed on. Now, as an investor, what are your options? To either hold your property, sell, or do a 1031 exchange. Now, the tax codes are property of a trader investment or a property held for investment. So you have to hold the property. You have to hold the property, and as Ben knows, real estate is cyclical, right? It's sometimes it's a better time to hold, sometimes it's a better time to sell. It just depends on where you're at. Some areas of property appreciate more than others, but it's going to be a property of investment where you typically have to hold it for a little bit. If you can always sell. You can always sell your property and pay your taxes. But the question is, if you sell and pay your taxes, it's fine. However, always think about what are you going to do with your proceeds after. Okay. Now, if you're going to reinvest the proceeds, can you achieve the same return on investment? And I always use this example. Let's say you have, let's say you met it out $1 million. I submitted out $1 million, and I sold multiple properties all over the state. Income tax, I'm on the highest tax bracket. There's I took a lot of depreciation. I'm going to be taxed roughly around 35%. Now, 35% of $1 million, I'm paid $350,000 to the IRS. So I net out $650,000. I can reinvest $650,000 in something, or I can reinvest $1 million. That's cash flow, real estate. Can I achieve the same return on investment reinvesting $650,000 versus $1 million? Can, maybe if it's hard, right? Mm-hmm. So a lot of people use the 1031 exchange strategically too. They want to grow their real estate empire. So let's say I want to leverage it. I'm going to put this $650,000 down as my down payment to buy a bigger asset. 75% loan to value. So now my buying power is 2.6 million. I've got $2.6 million asset that I can buy. Yeah. Versus if I had $1 million, I put that down, my buying power is now $1 million. I mean, $4 million. $4 million.
Yeah, and that's what we see the 1031 most commonly used is leveraging up and using that equity that are in your capital gains to borrow more and leverage it.
So, why do a 1031 exchange? The obvious reason is who wants to pay taxes? No one really wants to pay taxes, right? We want to defer it. Another reason is more purchasing power. A third reason that I always mention to people, it's about is estate planning, because this is a tax deferral. It's potentially if you do a 1031 exchange, it's potentially a permanent deferral. You can keep on going forever and ever and ever. Keep deferring as you continue to do 1031 exchange. So I'm going to do a 1030. I'm selling property A. I'm going to do a 1031 exchange to property B. And then once I sell property B, I'm going to 1031 exchange into property C. Okay. Now, if I sell property C, Uncle Sam is coming after me. He's in love with me. He wants the taxes. He was following me from property A, B, and C. He wants his taxes from B, C, B, and A. However, I died. I passed away. So Uncle Sam was only in love with me. So he's so sad. He doesn't want to. My daughter inherited my property. So he's not in love with my daughter. My daughter's too young for him. So he kind of goes away when I die. Okay. When my daughter inherits my property, she gets to step up in basis. Okay, so if she holds that property that she inherited for another 10, 15 years, well, she just earned her own Uncle Sam stalker. She has her own capital gain that she's responsible for. But her gain starts when the day she inherits her property. So it's strategic. And then the third reason, the third thing that the investor can do is just do a 1031 exchange. And I mentioned earlier, you don't always have to do a full tax defer. You can always, a lot of people choose to take money out at the end of the sale, a portion of it, as long as do a partial tax deferral and defer some of it and then keep other proceeds to themselves and spend it. Exceptions to the 1031 exchange, what can you not do? Really, I want to point out here, it's going to be stock and trade or other property held primarily for sale. So your house flippers, your developers, your builders, let's say Lennar Homes, they are a developer. They buy property, they build inventory homes. The inventory homes are their stock and trade. Okay, so that doesn't qualify because their intent is to build the inventories homes and then to sell it, to develop and sell. You know, so your builders and your developers do not qualify for a 1031 exchange. Your house flippers, you know, those people that purchase property, fix it up to sell. Well, your intent is to sell, not to hold for investment. So the tax code is property that's held for investment. You know, interest in a partnership, sometimes partnerships split. I do want to point out that, you know, interest in a partnership, when you have a partnership and you own an interest in that partnership, you don't own real property, you own an interest in a company. So it's a share, it's considered personal property.
Right, and we actually had a case recently from an investor who wanted to 1031 his real estate asset into a partnership, a syndication in multifamily, and that you can't do in 1031.
You cannot, because you're going from, I own real property, I'm going to sell my house or my rental house, I own real property, and you have to exchange it for real property. Okay, not real property to, can I buy interest in your company? Can I buy a share? That's not real property to real property. It's real property to personal property, to an interest in your company. You know. Mm-hmm. People will ask me, a lot of times they will ask me, how long do I need to hold on to a property for it to be investment property versus it being flip property? There's nothing in the Treasury regulations that defines how long that you need to hold on to a property. It's about intent. How long did you intend to buy this property as an investment property, or did you intend to flip? Now, a lot of times people say, well, how does the IRS, if it's all about intention subjective, how do they know? You know, the IRS can, nowadays, they can kind of see a lot of things. It's not like it was in 1980 or 1990, right? And so they can see when you purchased the property, how long you held it, what you did to the property. They can see your history, you know, do you typically buy property and you lease it out as a landlord, or do you typically flip? They can kind of see all that. And so, you know, we always recommend clients to speak to their CPA to see what they're comfortable with. A lot of CPAs will recommend holding a property for 2 years. A lot of less conservative CPAs will say hold the property for more than a year. You know, and doing a 1031 exchange, sometimes under a year, holding a property under a year is kind of aggressive. But at the end of the day, as an intermediary, we don't tell you how long. We pretty much tell you should probably talk to your CPA, because everybody's intent. It's a case-by-case basis, and they should refer back to their CPA to discuss on whether it is appropriate for a 1031 exchange or not. These are examples of some examples of Likekind Property. So when I mentioned the tax code, the tax code states that property of a trade or a business, or a property for investment. And so that's such a broad term, because an investment could be a single family rental house, a rent house. In Texas, we call it rent house. It could be a commercial property, it could be land held for investment. There's other, you know, specialized exceptions, like a vacation home, you know, or a property in a Delaware statutory trust. Those are exceptions by the IRS. But you can go, as long as it's from investment, a property of a trade or business or investment property to another. So it could go from a single family house to a commercial property. So sometimes I'll have, you know, an investor with several houses, and they want to sell all those houses to buy an apartment complex or fourplex. Or I've got a client with land. They want to sell the land and buy multiple rent house to cash flow. So that happens all the time. You can definitely do multiple properties. Now, this is the process of the 1031 exchange. So the taxpayer, let's say Ben is a taxpayer, and he's going to sell his property to John, right? And the property's going to be directly deeded to John. And at closing, John, the funds go to the qualified intermediary, which I'm the qualified intermediary. I hold the funds. That's when Ben's timeline starts. He's got 180 days to complete his exchange, but he's got to identify what he's going to buy first. Okay, so let's say Ben identifies 3 properties as his identified properties, and he decides to only buy 1 property. So Cindy, I'm going to buy this property. So he sends you the contract, the title commitment, and I use the proceeds I'm holding from the sale to purchase his replacement property, and that property will go directly from that seller back to Ben, and the property is deeded directly to Ben. So this is the most common exchange, which is called the delayed exchange. Now, when you identify, you have to identify by midnight of the 45th day, and this is calendar days. Okay, so holidays and weekends are included. So people will call me and tell me, is there any extensions on that? I'm like, no. This is a very crucial number for the client. So right now, it's been a crazy market where this 45 days is kind of tough sometimes, but you know, it is a hard number. There's no extensions unless it's a presidentially declared disaster. Same thing with 180 days. You have 180 days to close on the property. And let's say if you go into contract now and you close by December, you may not have a full 180 days because taxes are due April 15th. So you gotta complete your exchange, or you gotta before you file your taxes, or file an extension.
Right. Let me just qualify that, because a lot of people say, oh, 45 days is very, very short, which, you know, I guess it is in this market. But typically we start looking for replacement property during the sale of your current property. So if you're under contract, 45 days, 60 days, we'll start looking already, and even putting offers subject to the sale of your property. So I think actually in the case that we presented initially, I think the next day he closed on his property, he purchased one of his replacement properties. So he identified it the day he closed. He said, and this is what I'm going to buy, and we bought it the next day. And so it can sound short, but in actual fact, it's actually, you know, you've got some time there.
So when I mentioned you identify, you have to identify what you're going to buy. There's 3 rules to identifying, and you use one of the 3 rules. The most common rule is the 3 property rule, where you can just identify up to 3 properties, and they could be at any price point. So if you sold a property for $640, you can identify a property that's $600, $800, $5 million. Price does not matter, but you can only list up to 3 properties. The next rule is the 200% rule. So you can identify as many properties as you want, but not identify more than 200% of the sales price of the relinquished price. So if you sold for, let's see, 600,000, as long as you don't identify more than $1.2 million worth of property. Okay. And the third rule is the 95% rule. It basically means you buy 95% of everything you identified. And essentially on this rule, it just means you buy everything you identify. So this rule here, let's say you identified 4 properties, you can't use the 3 property rule, but the 4 properties that you purchase is 1.5 million, so you can't use the 200% rule. So in order to make the exchange valid, you need to buy all 4 properties. So that's the rule that's least used. But a lot of people are using the 3 property rule. And so these are the rules out of the Treasury regulations. It's got to be made in writing, unambiguously described, hand delivered, mail, telecopied, or otherwise sent in by the 45th day, and delivered to the qualified intermediary or a party related to the exchange that's not a disqualified person. That's your title company. So I just want to give an example of a client that was in that went skiing, and he didn't have his computer. We didn't give him, any forms. He filled everything. He was on his last day, and he wrote everything on a napkin. Took a picture on his cell phone, and then snapped it and sent it to us. And not the most professional way to identify, but it qualified. So that's part of the rules. Are there any other questions? I'm kind of getting to my Q&A, and hopefully this is a quick bit that would be helpful for everybody.
Somebody just typed in, what would disqualify a property from being used in a 1031 exchange?
It cannot be your home, your principal residence. It cannot be property that you're flipping. It cannot be a property, if your intent for the property is to sell, so let's say you're buying a property to build, to develop it and then sell it, that doesn't qualify. If you're flipping it, doesn't qualify. Your residence does not qualify.
It's anything that's investment, and that you're holding.
Yeah.
So it's a hold.
Yeah. So it's going to be a buy and hold property. Your intent has to be a buy and hold.
Okay, thank you. Everybody feel free to put any questions in the chat. Going back to Ilya's comment, just want to make sure we covered this. She had put, if you refinanced a house and took equity out, for example, higher mortgage, would you still have to have the same mortgage amount during the reinvestment?
Okay, so refinancing is absolutely fine as long as you do that after your 1031 exchange. Okay, so let's say of that 600,000 that was all cash, you bought another property that was 600 all cash, and you refinanced, you pulled the money out. I mentioned earlier, for a full tax deferral, you want to basically spend all the cash and have the same or greater debt. So just remember, when you pull that debt out of that deal, you took equity out of that deal, you have debt on that deal. So let's say you're holding that replacement property for another 2 or 5 years later, and then when you sell it, well, you're going to have the same match that debt. So you can definitely refinance it, but when you do purchase it, you're still replacing that on another 1031 exchange. You're still matching that debt.
Right. So I guess if you refinance before selling, you'll have to reinvest all the cash you have and have the same or greater debt. So let's say your asset went up in price, it's 500, you refinance, pulled out, you've got 100 in, 400 in loan. When you do that for 1031, you're looking for that same replacement. So reinvest all your 100 and have 400 or greater.
So if you do a 1031 exchange and you want to refinance, just complete your 1031 exchange first, and then at a later time after you've completed the 1031 exchange, you can refinance and pull the proceed, the money out and refinance, and there's no penalties to it.
Yeah, so that would be the case for refinancing after your 1031. Yeah.
Mm-hmm. Yeah. After. Keyword is after.
Yeah. Yeah, so there you penalize that.
And can you explain how the amount you are financing influences the transaction again, please?
So if the deal was just 600,000, you're going to buy another property that's 600,000. Okay. Now, if the deal was you had a loan on it, that loan gets paid off. You've got 400,000 cash, but you still have to replace that loan. You still have to buy another property that's 600,000, which means you have to get another new loan on your new property to meet that 600,000 minimum number for a full tax deferral. So in this case, your cash deal was all 600,000. You bought another property that's 600,000, okay? But you want cash back, so you're gonna put debt on it. You're gonna pull out the equity, which is fine. Nothing wrong with that exchange, but eventually, when you sell that property, you have debt on that property, and when you sell that investment property, you're going to have to replace that debt, match that debt on the third property, property C.
Okay, so they are putting, what about the depreciated value you have on your tax return? How does that influence this?
You depreciate the
that goes back to your slide for calculating the taxes.
Yeah. So when you depreciate, whatever you depreciate on your property, when you sell your property, you're going to be taxed back 25% if you sell your property, and that's going to be deferred if you do a 1031 exchange.
Yeah, so let's say you've accumulated $100,000 of depreciation over the 7 years you've held that asset. If you were to sell it outright, you'd have to pay 25% of 100,000, so 25,000 just on the depreciation.
Correct.
And let's say that property had a depreciation 200,000, then you get hit 15 or 20% depending on the tax bracket, long-term capital gains. And then depending on your income, you get hit 3.8%. So maybe that, if you want to show that slide, maybe again, that's,
Let me,
and if you live in a state where you have state income tax, then you get another,
Yes, they wanted
so
to.
there we go. Yeah. So let's say you've got 100,000 depreciation, 25% that plus your capital gains. If you've got 200 in it, 15 or 20%, the net investment tax, and then depending on where you reside, your state income tax too. So it can get pretty pricey to.
It can be very pricey.
It can be very pricey, especially, you know, if you've held an asset, you know, typically investors turn them around every 5 to 7 years. Yeah, you can calculate that out for your own investment and see it can be a little bit pricey.
It's almost kind of like instead of paying your taxes, you're rolling into your next profit. It's almost like an interest-free loan from the government, you know. So let's say, you know, like I mentioned earlier, on my value of $1 million, I'm paying roughly around $350,000 in taxes. Instead of paying that to the IRS, I have a better asset, more purchasing power. It's almost, you know, it's almost like an interest-free loan.
Yeah. Any other questions we have, Sandra, in the chat? In investment, this is a very, very powerful tool. I think on a previous webinar, we talked about the wealth drivers in real estate investing. The tax benefits are pretty big. You can't do this kind of thing in the stock market or anything. So only in real property investment can you do this.
I'm happy if there's any other questions later on. I'm happy to be a resource if anyone wants to reach out to me.
Right.
Directly. I think this is going to be recorded.
It is recorded. Yeah, it'll be replayed for some who've signed up and haven't managed to come on today. And you have our contacts, I think. So the 1031 exchange sort of space is unregulated. So we always partner with API because they're, you know, you're owned by, I believe, Stewart Title. That's a publicly traded company. So at least this is our recommendation at HNB, is to have a very solid partner. You don't want your qualified intermediary to run off with your funds or go bankrupt.
That has happened. So we are, and whereas we've been, as a preservation, we've been around since 1990. We've been a part of Stewart Title, which is a publicly traded title company. We're on the stock market since 93. So we've been a part of them. So they can always check our stocks and, you know, our financials. We're insured, we're bonded. We don't commingle our clients' funds. And we have a separate account for each client. So if at the end of the day, I do recommend, if you're going to use a qualified intermediary, use a reputable one. You want to make sure that they've got good financials, that they're just not going to disappear.
Yeah, no, that's very important. Something we didn't, I think, talk about earlier, but yeah. All right.
Okay, I think those are all the questions we have so far. Would you like to share your slides with your social media where people can find you?
Sure, we can share the presentation and the slides, I think. Yeah.
Okay.
Yeah.
Thank you so much for having me.
Yeah, no, thanks for coming, Cindy. Thanks for helping us on the 1031s. We've got one closing at the end of the month. That's doing sort of what we talked about, single family to commercial property. So that's going to be an exciting. So thanks for coming, for partnering with us, and don't hesitate to reach out if you have questions to Cindy directly or to us, or if you're considering, you know, upgrading your assets, transferring it like this investor did to try and yield some more cash. Definitely options we can run in scenarios and see how that pans out for your specific case.
And by the way, this is a federal tax code, so you can buy and sell property anywhere in the U.S.
Can you go to the next to last slide so people can see where to find you on social media?
Oh, at the end, yeah. So I'll click here.
There you go.
Oh, there you go. Yeah, so we've got
Okay, so
this is
for HNB. So make
that's for
sure.
HNB, and this is for API.
Yes. So if you want to find API and learn more about the 1031 exchanges or connect with Cindy, these are your channels, correct? YouTube, Facebook, LinkedIn, and Twitter. And we will also be reaching out to the attendees to provide all the contact information.
Great.
Thank you everyone for joining and have a great day.
Thank you so much. Thank you, Sandra.